How difficult is it to beat the S&P 500 index? Fund managers receive major bonuses for doing just that, sometimes even if their results are not profitable. Most fund managers do not consistently outperform the index, and that information alone should tell you that it's really hard to beat the S&P 500 index. Let's take a look at the entire history of the SPY ETF, which is a tradable instrument that mimics the S&P 500 index, and let's add a simple technical indicator to the chart. The 200-day moving average is a popular technical indicator used by traders and investors to evaluate market trends. In this video, I want to see if we can beat a buy and hold strategy by using the 200-day moving average to trade in and out. When you see a chart like the one here, it's easy to conclude that if you bought SPY when it started an uptrend and exited when it started a downtrend, you would have a profitable trading system for SPY. But would it beat buying SPY at the start of the chart and selling at the end? That is, would it beat a buy and hold strategy? To test this out, we need a way to detect the slope of the moving average. The lower indicator does just that. It's giving buy signals in green whenever the moving average turns up from a trough, and sell signals in red whenever the moving average turns down from a peak. And these signals can be used in our trade simulation. But notice that while the human eye can easily determine the perfect turning point if it sees all the data, the moving average slope detection code is strictly rule-based and does not see future data points, and so it picks out multiple turning points based on smaller duration turns in the moving average. Eventually, it gives perfect buy and sell signals, and the trader can participate in the multi-month rallies in SPY and avoid the multi-month downturns. For instance, by exiting SPY during the dot-com bust, you would have avoided the multi-month downturn and would have gotten back in on the upturn. There are two other downturns lasting a year or more on the chart that would have been avoided. This one is the bear market of 2008, and this one is the COVID sell-off. So what's your best guess? Buy and hold SPY or trade in and out based on the peaks and troughs in the 200 moving average? Well, here's the equity curve of the traded SPY system in black with the buy and hold equity curve in gray. And we can see that the traded system ended at $351 after starting with $26.5, whereas the buy and hold of SPY ended at $491 after starting at the same level. And we can see where the traded system was out of the market for those long downturn periods of 2001 to 2003, 2008, and 2022. As we know, these were good times to be out of the market and save the equity of the portfolio during those times. And up until 2011, the traded system was doing better than the buy and hold system. But since then, the buy and hold system has outperformed. How is it possible for the buy and hold system to outperform the traded system if the traded system is able to avoid lengthy downturns? And the answer comes down to the fakey signals. It costs a lot to trade in and out during times of indecision in the moving average. For instance, the system is only entering and exiting the trade at the close of the signal bar. So during those times when you get multiple entry and exit signals close together, you end up entering the trade at a high price and exiting at a low price. So even though the system saved you during prolonged down periods in the market, it cost you during wavering times. But that might be an acceptable price to pay for the protection it offers during prolonged down periods. When devising a trading system, it's important to perform backtesting to validate your ideas. In our example, you might have intuitively concluded that only trading SPY during uptrends would outperform SPY. But there are nuances to consider, such as the cost of trading in and out before a strong trend arrives. Using this simple moving average system, it was profitable, but it didn't outperform SPY. But there are many technical analysis indicators that could be tried, and there are obvious ways to improve this moving average technique, such as trying to reduce the number of fakey signals. If you like the idea of testing various market hypotheses, Please join our email newsletter and get regular information showing techniques and suggestions that you can put to use in your own trading. See the link in the description. And if you want to try this exact test for yourself, please visit the blog for detailed instructions.